The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness. By Morgan Housel. The author, Lars Tvede, is a successful investment banker, fund manager, and derivatives investor. He is also the best-selling author of The Unavoidable Economic Cycle. In many ways, Tvede is a market shark skilled at capitalizing on market movements, but he also writes books teaching retail investors how to avoid risks and protect themselves. It's like a gambling master teaching players how to beat him. This book has been reprinted over 50 times and has been a global bestseller, which isn't surprising given its content. The Psychology of Finance presents a crucial idea. The immediate factors influencing financial market prices are the psychology and perceptions of market participants. I'll break down the key insights of this book into 3 parts. 1. The 4 basic principles of financial markets. 2. What information is most valuable in financial markets? 3. How investor psychology drives market ups and downs. Let's start with the first part, the 4 basic principles of financial markets. Let me begin with the historically famous Wall Street crash. 1929, the U.S. stock market had been in a 10-year bull run. At that time, everyone was speculating on stocks, believing they could only make money. But on October 24, the market suddenly began to plummet. In just 2 weeks, $30 billion vanished, equivalent to the total expenditure of World War I. The crash finally hit bottom on July 8, 1932. In those 3 years, the U.S. GDP halved, 110,000 companies went bankrupt, 8,800 banks closed, and 17 million people lost their jobs. Yale University economics professor Irving Fisher was not spared either. Once the wealthiest economist in the world and known as the Wall Street prophet of the 1920s, Fisher saw his $15 million fortune evaporate in the crash. By 1935, Yale forced Fisher into retirement, and he still owed friends and family $750,000. In addition to Fisher, the most famous economist of the 20th century, John Maynard Keynes, nearly went bankrupt during that crisis as well. You might wonder why even the world's most authoritative economists lost so heavily. Moreover, since the 1929 crash, financial crises of various scales have occurred frequently, leading to similar tragedies. Did people learn any lessons? There must be some mysterious forces in capital markets beyond financial theories. The Psychology of Finance summarizes 4 basic principles of these mysterious forces. The first principle is that the market precedes the economy. The stock market is a barometer of the economy, reflecting economic trends in advance. Generally, the stock market declines during economic downturns before economic indicators show a downturn. The stock market stabilizes and rises ahead of economic indicators when the economy improves. Why can the market reflect economic trends in advance? Because investors on the front lines of industries have expectations of upcoming changes. Suppose investors in a particular sector notice declining orders for leading companies and reduced demand. In that case, they will sell those companies' stocks, potentially recognizing risks before the company's management does. Conversely, they will buy its stock if they notice booming orders and strong demand for a company. This market insight forms the basis for the stock market's rapid response. How far ahead does the stock market lead the economy? Bruno Solnick, the first president of the European Financial Association, reported that the time from market reversal to economic reversal is about 6 to 9 months. In other words, the stock market leads the economy by 6 to 9 months. When the stock market has risen for 6 to 9 months, corporate sales and financial indicators start to reflect the improvement. However, it's worth noting that manipulation and intervention are often present in the stock market. According to Tvede, the market is only sometimes correct, and the barometer is sometimes off because markets are often irrational. The second principle of financial markets is that the market is irrational. In the 17th century, the Netherlands was the most developed capitalist country. During that time, the wealthy Dutch class saw tulips as a taste symbol, leading to increasing popularity and rising prices. At the peak of the craze, a single tulip bulb could be worth as much as a brewery. The tulip mania attracted foreign investors, who bought heavily when prices dipped slightly. Eventually, people began to question the actual value of tulip bulbs, leading to panic and collapse. Once priced astronomically, tulip bulbs became worthless, causing widespread financial ruin. The tulip bubble plunged the Netherlands into a prolonged economic depression, losing its status as the world's leading empire as Europe's center of prosperity shifted to England. This story illustrates that markets consist of thousands of individuals whose collective emotions lead to greedy buying and fearful selling. People's wild imagination controls the market, which becomes hysterical. This collective irrationality proves the third principle of the stock market: predicting long-term economic trends is impossible. Why? Because of the butterfly effect. The butterfly effect means a small action can trigger significant reactions. There's a saying in financial markets that an old lady in Brussels selling a small amount of bonds can trigger a crash in the Japanese market. In other words, market developments are entirely unpredictable, and any small change can lead to vastly different outcomes. When stocks rise, everyone jumps in; when stocks fall, everyone tramples each other. Human nature magnifies small gains, minor losses, or even slight disturbances. You might predict a market drop but cannot predict when it will happen or how far it will fall. Because minor details often influence the economy, predicting long-term trends is futile. One of the greatest investors in history, Peter Lynch, also said not to try predicting market trends a year or two in advance; it's impossible. Since financial markets are unpredictable, what value do economists and market analysts have? Although financial markets are unpredictable, their research efforts help align market psychology closer to the objective world, making expectations more consistent. Although they often get it wrong, their work drives the alignment of market expectations with reality. Traders hope to use technical charts to discover price patterns to overcome market irrationality. However, technical charts are also the result of psychological influences, leading to the fourth principle of financial markets: technical charts are self-fulfilling. What does this mean? It means that technical charts result from trading behavior. For example, suppose the market comprises 1,000 strong investors, 900 of whom are technical investors trading based on stock charts, while the remaining 100 are value investors trading based on fundamentals. All are bullish and buying in, causing a steady market rise. However, at a certain price level, such as a previous high, all 900 technical investors decide to sell, while the 100 value investors wait and see. Eventually, 900 sell orders flooded the market, causing a steep drop. After some time, the market rebounds, and prices rise again. This time, the 100 value investors remember the last drop and decide to exit at the previous high. As a result, all 1,000 investors act simultaneously, demonstrating the self-fulfilling nature of technical charts. Most people use similar technical analysis tools and take the same actions, ultimately making the chart pattern self-fulfilling. Investing is a highly complex activity. Professional investors typically earn more than most market participants because they have better access to valuable information beyond differences in financial knowledge and investment skills. Making sound decisions requires having genuinely helpful information. Let's move on to the second part. What kind of information is most valuable in the financial market? According to Tweed, information in the financial market can be classified into two main types: news and transaction information from market participants. Tweed believes that news is essentially worthless. He cites various examples to prove that the market often moves contrary to the news. For instance, Businessweek's cover story suggested that Treasury bond prices would continue to fall, but the prices began to surge soon after. Similarly, another cover story declared that stocks were still the best investment, but the stock market started declining, hitting record lows 3 months later. Why does news often run counter to market trends? Firstly, people take for granted that the media's information is always accurate. However, publicly available news can be ambiguous, contradictory, or false. Prussian military theorist Clausewitz said that most unfiltered information is wrong and cannot accurately reflect market trends. Secondly, the value of news diminishes the moment it is released. As previously mentioned, the market moves ahead of the economy. Before any good or bad news is officially announced, the market price has already reflected people's expectations. Therefore, when the news is officially released, the price is often already at its peak or trough. Thirdly, the overwhelming complexity of news can cause significant stress, leading people to doubt even what they were sure of and make erroneous decisions. In reality, what directly influences financial prices is people's judgment and perception within the market. The media cannot predict collective perception. Therefore, Tweed believes that news information is not valuable to investors and can be misleading. You cannot make money by following financial news. If you want to make money, focus on the transaction information of market participants. There are two types of market participants: market bigwigs and retail investors. Retail investors are generally the most minor-savvy players in the market. Bigwigs typically earn more than most other participants. Following their moves can help you make money. Tweed categorizes market bigwigs into three types. 1. Executives who own more than 5% of a listed company's shares. 2. Capital giants in the stock exchange. 3. Financial arbitrageurs. Currently, the trading behaviors of these key market players must be reported to regulatory authorities and made public. This publicly available information can provide clues. First, if a company's executives sell a lot of company stock, they might need cash for personal use. However, it's more likely that they know there are problems within the company, which is a warning sign. Conversely, if executives are buying large amounts of company stock, they likely believe the stock is undervalued or that the company has promising prospects since they know the company best. Tweed says that following the transaction records of company insiders is more valuable than reading 1,000 profit forecasts. Next, capital giants are the major players, including social security funds, insurance institutions, mutual funds, securities companies, and QFI, qualified foreign institutional investors. These are state-owned or large commercial institutions whose actions can influence market trends and rotations. If data shows they are selling large volumes, it indicates that the market is about to decline. Conversely, if their selling volume is a small part of the total market selling volume, the market is unlikely to drop. Finally, financial arbitrageurs are the first to detect price changes and use financial transactions to avoid risks. They have rich market insights. Tracking them can help you anticipate price changes. Why can financial arbitrageurs detect price changes early? Many are frontline workers in specific industries, such as iron ore, crude oil, and coke. When they perceive a decline in raw material prices, they preemptively sell in the futures market to avoid company losses. So, if you see arbitrageurs selling, it's likely that prices will fall. Let's move on to the third part. Investor mindset, how it drives market rises and falls. The mindset represents hidden desires and wishes that we may not even be aware of, but it undoubtedly influences our actions. Tweed points out that 4 types of mindsets easily influence both professional and retail investors' trading behavior. 1. Regret. When the stock market has already risen and you haven't entered, a strong sense of regret arises, almost to the point of beating your chest. When the stock price falls slightly, you can't wait to rush in to correct your previous mistake. This regret psychology is expected in the stock market. 2. Arrogance. People subconsciously believe that success is due to their efforts rather than luck. Many investors become overconfident after making money in the stock market, subconsciously thinking they have mastered extraordinary investment skills. Under this arrogant mindset, trading becomes less cautious and more frequent. In the investment world, it's rare to see frequent traders achieving stable investment returns. 3. Conformity. It is about going with the flow. People are particularly susceptible to conforming to the opinions of the majority, striving to maintain the same stance and actions as the majority. If others buy, they buy. If others buy at a specific price, they do the same. 4. Self-defense. If people's behavior results in outcomes contrary to their expectations, they won't readily admit mistakes, but rather ignore or distort uncomfortable information and actively seek favorable details for comfort. For instance, when facing severe losses in the stock market, people are reluctant to check their stocks or open their accounts to see the actual losses. They avoid listening to unfavorable news, but pay close attention to favorable news and even start trading based on it. Tweed believes that the rise and fall of the stock market result from different mindsets. When is rising trend? Many people are still determining at the beginning of a market rise and do not enter the market. However, some insightful investors do. As the stock price gradually accumulates gains, most investors regret not buying earlier and are eager for the price to drop so they can follow the central funds. When the price falls slightly, they rush in. This buying frenzy further drives up the stock price, attracting the attention of stock analysts. With their promotion, more and more investors enter the market, increasing the price. Investors who taste the profits feel making money is easy and continue investing, driven by their arrogance, believing they can earn more. As more people buy in, the stock price further rises. Listed companies also find it easier to raise funds from the market, which they invest in the real economy, promoting economic development. A good economy, in turn, supports the stock market's continued rise. Finally, the selling voices become almost inaudible, and everyone only hears the bullish voices, maintaining unanimous buying actions. When will the rising trend continue? Tweed summarizes 2 simple methods for judgment. First, look at the previous dense trading area. A dense trading area is where the daily K-line stays in a price range for a while, with considerable trading volume. If the price does not fall back to this area, the trend will remain intact. Conversely, if the price falls below this area, sell. Second, look at the chart pattern. The rising trend will continue as long as previous highs become subsequent lows. Conversely, if the price no longer shows higher highs and higher lows, the trend is reversing. When is falling trend? In a bull market, everyone is fully invested. However, when the stock price falls, especially with full position losses, people experience tremendous mental pressure. Under this immense pressure, changing attitudes can take hours, minutes, or even seconds. People start to think the market prices are too high and believe the decline will continue, leading to new selling pressure. Continuous decline results in herd panic, causing another round of drops. At this point, only bearish voices are heard. If the psychological basis of a bull market is the regret of not buying early enough to make more money, then the basis of a bear market is people's aversion to loss. So, has the market bottomed out if it has fallen so severely? Will the decline continue? How to judge? Tweed points out that the downtrend will continue if the head breaks through previous bottoms. Volume as an indicator. Although there are many technical indicators, Tweed emphasizes that people's perceptions and emotions drive the market. Reviewing the critical content. First, we explained the 4 basic principles of the financial market. Second, we introduced the 3 most valuable types of market information. Finally, we described the psychological mechanisms behind market rise and fall trends. People think they have learned many lessons from financial crises, but repeatedly fall into crises. The deeper reason is human nature and psychology. Tweed's final reminder is that people should listen to what the market is saying, not what investors are saying.